Good afternoon, everybody. My name is David Jennings. I'm Chairman of Movers and Shakers. Great to see so many of you been able to join us today. So welcome to all of you. For those of you who don't know Movers and Shakers, we're the UK's leading property and construction networking forum, now in our 25th year, bringing together key players from public and private sectors across the UK. We've been organising virtual events since April, a mix of interviews, presentations and webinars. All of these can be viewed on the Movers and Shakers YouTube channel, so do take a look. And welcome to our final session in a series of 3 webinars exploring real estate investment and asset management organised in partnership with Yardi. Now, we kicked off a few weeks ago with the session Dynamic Asset Management in a Post-COVID World, where we took a strategic perspective. Last week, we had a session Adapting to Change, Delivering to New Agenda, where we took very much an operational portfolio perspective. Today, our theme is Best-in-Class Asset Management, Looking to the Future. So a little bit about Yardi. Yardi are a global PropTech provider with more than 7,000 staff active in 80 countries. A staggering 12 billion square feet of commercial space is managed on Yardi platforms. They support the full spectrum of sectors, commercial, retail, logistics, residential, and co-working. Yardi offers solutions for property managers, asset managers, investment managers, and property marketeers. Their newest suite of products is Yardi Elevate, which helps asset managers with forecasting, deal pipelines, leasing, construction, and investment. So thank you to Yardi for their support. Now, up until recent times, real estate has been a very predictable market with conventional real estate leases underpinning most assets. So what have we learned from our first 2 sessions? Well, we agreed that a significant change is taking place in real estate, particularly around occupier needs. More flexible leases, turnover leases in retail, shared workspaces, etc. were already happening, but that the pandemic has accelerated this process of change. We agreed that offices would still function very much in the way that they have, but that design and workplace criteria would change with more flexible workspace patterns. The principles behind property, example, the importance of location, would still remain, but we agreed also that retail would see the biggest challenge and would likely see the biggest change as an asset class, perhaps not surprising. Investment models would evolve, potentially with high risk, high return profiles. Greater alignment between occupier and building owner would happen, driving the need for greater trust and transparency and more intensive engagement. Being adaptive across all asset classes was seen as being critical. Data would become more critical, technology more integral, and management more intensive. We agreed that real estate was very much behind the curve in the use and application of technology. We agreed that alternative asset classes will develop, driven by the dynamics of the market and, of course, the flight for better returns. Asset management, we agreed, had to adapt to thrive in this changing environment. Today, we bring things to a conclusion with our theme, Best-in-Class Asset Management, Looking to the Future. And to make sense of what's happening, we have a first-rate panel. Welcome to Audrey Klein, Head of Fundraising, Kennedy Wilson. Roelof Opperman, MD, Real Estate Technology Investment at Fifth Wall. Neil Gimasma, Vice President for International at Yardi. And our Chair, Anna Sabine, Chief Executive at MEPC. Now remember, you can ask questions by using the tab at the bottom of your screens. Now we're going to kick things off by asking Roelof to give us a perspective on the changing dynamics of the investment market and the disruption and change and innovation taking place. Roelof, over to you.
Perfect. Okay, great. Thanks, everyone. I'm Roelof Opperman. I'm, as David said, a managing director at Fifth Wall. We're a large venture capital firm focused on prop tech, and I run our European group. So we work with a lot of big asset managers, and I think the thing we're thinking about a lot is kind of the space we're in right now, the world we're in right now, and just kind of how are asset managers in this particular environment going to get alpha, right? I think that traditionally we all know that markets were often opaque, illiquid, fragmented, but now in developed markets, they're much more transparent, much more liquid. I think we all agree that, traditional returns or local knowledge and relationships, really at the end of the day aren't driving as much alpha as they used to. And so when we think about that, right, the managers that, need to generate what we call kind of smart beta are going to have the data capabilities to do that at scale. So we think in terms of the beta, you're really going to need extra insight or an edge in terms of how you look at an asset or additional data. In addition to that, in order to generate the alpha, we do think that operational advantages and the adoption of technology really at scale will likely provide a competitive advantage to certain GPs versus others that don't. In addition, what's nice about technology is it tends to be a leverageable asset. So what's nice about that is if you get those operational advantages through the adoption of technology, those competitive advantages kind of differentiate yourself, one, but then the additional thing about that is if you have superior people and processes, it actually is a leverageable item. So instead of it just being a 1x, so okay, I have better technology, I have better process, I have better technology and better people, and that's 1 + 1. It really is that if you have better technology and better people, it's 1 + 1 = 10, because of the fact that those people are able to leverage the technology. The additional thing I think to look at this particular scale is that I do think that we all sense that based on that, you will have a flight to quality in terms of managers. And then also, I think that scale is going to matter here. And so the smaller players that are out there that aren't able to adapt as nimbly or don't have the resources, I do think that we all have an opinion that it's going to be very challenging out there. And so we do think that, when you have scale, when you have the ability to invest in these types of items, it is going to be not only a differentiator, but it will increase your size and increase your competitive advantage. When we go to the next slide, again, we're talking about the fact that tech-enabled models will differentiate these asset managers. I think that, you'll look at it initially just at the operational performance, right? And breaking that out, that can, kind of be two things above NOI, which is obviously you can increase revenue with additional products, ancillary revenue streams. You can also do, increase your necessarily kind of your core revenue through, better pricing, more accurate pricing, and in additional, retention tools that will obviously help in terms of your valuation. You reduce maintenance, improve utility efficiency, reduce staff and labor costs. All of those things are going to help you on the NOI front. And then there's also indirect costs that technology helps you with, right? Optimize and defer CapEx, and then improve your capital efficiency. There's then a number of other, big components that, create that differentiation for asset managers. I think one is certainly the asset value, right? So you're going to get achieve a premium valuation for the asset at portfolio level through technology, and definitely a better equity multiple because of the fact that you have a superior brand and a superior operating model. Your brand and reputation increasingly is extremely important, especially this environment where people are thinking, is it safe to go to work? And so they're looking at their landlord as a counterparty, and corporations are increasingly looking at that. And so your brand does matter. And then I think a big thing in this environment is just risk mitigation, right? No one wants to be that landlord that has an outbreak in their building, right? No one wants to be that landlord that has issues with their tenant that inevitably end up in the press. And so technology is all going to help you in each of these specific areas. And we, a lot of times when we're talking about technology in real estate, we're talking at an extremely high level or in the clouds and, robots, flying buildings, these types of things. We always like to bring it back down to earth, practical examples. There's a few I want to pull out here, but full disclosure, all of these companies, except for one, are portfolio companies of Fifth Wall. So I'm very biased when I talk about this slide, and I always like to just put that out there. I think there's a few that are quite interesting, and I really like to talk about. And again, they come down through a few big buckets. I think one is, again, adding new products and ancillary revenues, increasing your core revenue, reducing maintenance, improving your utility efficiency, reducing staff cost, optimizing your cap desk, and improving your corporate efficiency. Some that I like to point out is one company here called SmartRent. And what they do is their home automation platform. So think about a smart home platform for build to rent or multifamily units. Incredible company. Payback period is just under 3 years, and you're seeing a 52% IRR over 7 years for a lot of the people implementing. Again, these are averages, so it really does depend on the asset. Another great company out there is Cobalt. I really love talking about this company. It's a robot that replaces a security guard. So it literally is a autonomous robot, roams around, has a touch screen on it, can replace a security guard through superior computer vision. In addition, is very friendly for people. So if someone's lost in a shopping center or lost in an office, it can go up to the robot will give it directions. It also has advanced computer vision capabilities where if it sees something, it'll alert the main security area. So for instance, if it sees someone fall, it's programmed to alert main central authorities or alert people to look into it to make sure that that person's okay. A really cool company. We're generally seeing about 20% savings per year in security, and again, about a 3 to 4 year payback, depending again on the specific applications. And one that I think, again, is kind of a new way, especially within retail, which is obviously going through a even more challenging period, is a company called Appear Here based in London. What they do is they really are a marketplace for short-term rental leases. And so what they'll do is they will basically allow a tenant to do anywhere from literally a week lease to a 6 to 7 month lease. And the beauty of that is not just facilitating that, they'll actually set up the space and facilitate that actual lease. But the cool thing about this is it actually opens up the aperture for potential customers to your space. So what they'll do is they will actually get Google and Spotify and these types of brands to take those spaces. In a sense, you're getting an increased customer base into retail outlets, which I think is key. So I think in terms of the overall picture, hopefully we painted you a good picture in terms of the state of play of where we see it. In terms of COVID, I think we'll talk about later the effects of COVID, but that's how we see the state of play in terms of asset management and technology and innovation.
Thank you, Roelof. I'm now going to hand you over to Anna and to our panel.
Thank you very much, and thank you very much, Roelof, for that. And nice for those of us to answer Checky to see what you might mean in practice. I think we want to try and skim through 3 different sections today. We want to talk a little bit about investment and how we're going to transact with real estate in the future, who's investing, can real estate become more accessible. We're then going to have a quick skim through technology and data and how it can transform investment and asset management decision making. And then we're going to finish off by talking about new asset classes and what are the asset classes that technology can enable. So as David said, if you do have questions, please do submit them. You may have things you want to ask that I'm not covering, and please do jump in and I'll manage those. So let's start by talking about or agreeing, if we can, what the biggest drivers are going to be for change and what the real estate market's going to look like in the future. Neil, do you want to jump in first on that?
Yeah, it's a big question, Anna, actually. I think there's a few things that are happening from a real estate investment point of view. And I think one thing is that investors increasingly are looking at multi-regional type of investments, number one, so not investing just in one geography. And I think the other aspect is that they're increasingly looking at investing in multiple sector. And so rather than traditionally just investing, let's say, commercial, i.e. office, core plus, but increasingly hedging that into other subsectors as well. And I think that creates complexity in general speaking in terms of both how to value as well as then how to report against. And so those would be 2 examples of changes that we see.
Audrey, do you just chime in with those, the other key changes?
I think for obvious reasons, investors are very hesitant on the office sector. People are waiting to see what's going to happen there. I mean, it's a real wild card. I personally think that the office is here to stay. I mean, I think that, one of the things that we think is going to reemerge is the business park, the suburban business park. It's kind of like the happy medium. It lets people still go to the office and be together, but not necessarily go into the city. And I think that people who know how to cater to that type of office asset class are going to be winners in the end. People want certain amenities. The office park has come a long way, actually. And so I think that as far as like office parks go, I mean, as far as like the office asset class goes, that's going to be something that reemerges. Industrial is the flavor of the hour. You know, I mean, everyone is piling into industrial. There's a lot of money going into industrial, which is industrial / logistics, which is a little worrying to me. But you know, it has been the clear winner out of this whole COVID situation. You know, I mean, driven by e-commerce, of course. If I, you know, the people who try to stay ahead of the curve are looking at hospitality. You know, I mean, hospitality prices have certainly corrected, and you know, when we reemerge from this current set of circumstances, hospitality is usually the first to come back. So, you know, and I do think that that's going to maybe change size and shape as well. You know, so anyway, really interesting dynamics I think we're going to see coming out of where we are now.
I know I don't want to rehash the chat from last time, but I'm always intrigued by this idea that offices are coming back. As a business owner that has decided we're going to go officeless as a result of COVID and how well it's worked for our team. So it's interesting to see. I think we're all hoping it's going to go back to how it was, but I'm not sure it will. Roloff, do you agree with that analysis of what you think is going to be kind of happening going forwards?
Yeah, I mean, full disclosure, I'm not a real estate investor. I'm a tech person that follows real estate, but and obviously I come from a real estate background, but I do think that's right. I mean, I think that what I would describe it as is you've got a short-term period of some changes and then a longer-term period where there'll be more sustainable changes. So, you know, I think with a vaccine or a herd immunity, obviously some of the shorter-term things like the intense sanitation, et cetera, you know, will go away, right, hopefully, and we won't have to do that as much. And I think, you know, moving to the cities and those types of things will come back. But, you know, that may be a year or two, right? And then there'll be the longer term changes that are part of that. So talking about the longer term changes, you know, we've looked a lot at past pandemics and studying them and looking at technology and innovation and change. And the truth is it's not really that the pandemic changes anything, it really just accelerates everything. And so what I would do is I would just look at what you thought was changing or moving prior to the pandemic and just move it ahead 5 or 10 years, right? So e-commerce penetration is a great example. You know, people were working from home before in a capacity, right? I mean, what was the actual occupancy on a Friday of Canary Wharf or those downtown areas? It was probably pretty light, right? So I think that you're going to figure that out. I think the keys to watch is I don't think the office is dead. I just think that we're using this term now called omni experience, right? Or omni work, where it's just like you order things online or you go and shop. You work from home for things you can do at home, and you work in the office for things you can only do in the office. And I think the dynamic now is that likely what you'll do is kind of a 3 and 2 thing, right? Where everyone says, okay, we're in the office Monday through Wednesday, and then Thursday, Friday, we're off. And I think the key of that is that it's all an experiment. So right now, working from home seems to work, but companies are going to be super, super focused on productivity metrics. And anytime that productivity metrics start slipping, they're going to try to go back to default. And so I think every company is going to go through their own experimentation, but I have to think that unless something is totally wrong in the data we're seeing in the occupancy data, you're going to have a diminishment of office, right? I think anywhere on the scale of, who knows, 20 to 30%. And so what that's going to mean is it's incumbent on office owners to figure out, you know, to play a new role, which is to convince people to come to the office. And that was not something they ever had to do before, right? Before it was just you come to the office, that's it. But now they're going to have to convince it. And it puts office owners in a much more role like a hotel owner or a retail owner. And that was something happening anyway, right? I think the hotelization of office was something we were seeing. If you walk into a Class A building in downtown London, or, you know, I guess the city London, it's not that much different than to walking into a beautiful hotel, right? So I think people were moving that way anyway in terms of focusing on the services and experience. And I think the companies that do well coming out of this are going to focus on that for their particular tenants. One other big thing, I think that you're going to see really, I think, at retail particularly and other kind of obsolescent retail assets or other categories, let's say small offices, et cetera, I think you're going to see a huge economic and seismic shift in that area. And I think there's 2 reasons for that. One, it appears that the government is very empowered to do that. It seems like they're very much pushing that and have the power now to push through a lot of changes and development changes. And two, you've got all these innovative concepts that are coming out for new purposes. And we're going to talk about that later, but I think that you're going to see high street completely change. You're going to see these retail areas completely change. And I think that's overall a good thing. It's obviously going to be painful in the short term.
I think just
Well,
to add to what Roloff said, I was going to say that one is I think there's a paradigm shift that's happened now because of COVID, and that's the fact that the world was forced to work from home. So there wasn't an industry necessarily that was an exception to that push. And with that, it's also brought this innovation in terms of people adapting, whether it's Zoom or name your online platform. So there's this cadence that's developed for people being comfortable from working from home, but almost a forced acceptance that companies have had to enable individuals to work from home. And that's led to additional technology investment, et cetera. I think the big question will be for offices, like you say, it's not going to go away, it's just going to be repurposed. And I think the big change that will happen is that large corporate occupiers won't lease out a 10 to 15-year commitment with different steps. They won't necessarily reduce their employee population, but what they'll do is give greater flexibility in terms of the space that they're required to let. So an example would be is rather than letting out 1 million square feet, they might let out 600,000 square feet. And then within that same building is have a requirement to maybe let out, say, 200,000 square feet, which is flexible space, which is either done by a third party and or by the building owner themselves. And they may pay a higher rate for that, but again, their duration of that long-term fixed lease is going to be shorter. And then employees will also, I think, have a greater flexibility of moving into a hub and spoke model. Audrey, like you said, that this aspect of whether it's these business parks or other areas by which the commute won't be as long and as tedious for portions of the employee base. And there will be greater acceptance that people have greater flexibility in terms of how they work. And I think that will lead to just changes in behavior as to how office and specifically is configured, but also then what the lease terms are and the commitments are that corporate occupiers have to give. And we're already seeing that in terms of renewals across the business.
So, Audrey, did you want to come in there?
Yeah, there are two things that maybe you should think about when you think about what direction office space is going in. Look at the countries that handled COVID a lot better than the UK and other countries. So look at Germany and look at Korea. They haven't stopped going to the office. Okay, it's business as usual there. It's a little different. So in Korea, you walk into your office building and you get your temperature taken before you go upstairs, and everyone's wearing masks. But people are going back to the office and they're in the office, and the same is true in Germany. So, unless it's a big international corporation where they have mandated that you must work from home. So, so that's one point. The other one is I have had 4 industry organizations reach out to me and ask me to mentor 2, 3, 4, 5 people, okay? Young people. I have never mentored so many people in my life as I have in the last 6 months. Okay. In my life. And, all of these younger people are starving to be around senior people and find out what the way is forward, what the path is, how they advance. You cannot grow your young people remotely. You cannot do that. They have to be around you. They have to be around you. They have to be around senior people. They need feedback, they need that human interaction, and all of them. I've got 20 of them.
But isn't that ironic that it's that demographic that always wanted to work from home and have more flexibility, et cetera, and all of a sudden now is the first demographic that says, no, I want to go back to work, right? I want that physical connection. And maybe it's because of that mentoring and that idea that you need to be in the workplace also to learn and maybe be promoted faster or whatever, all these other different components. But maybe it's also just the psychological component that the demographic also maybe doesn't have a partner and they live alone, right? So there's other social components coming into that.
Jumping in there, I think some of our younger staff would say they never wanted to work from home. It was those of us with nice houses and gardens.
Yeah, well.
That were happy to work at home. I don't think the kids in their flats necessarily wanted to, but
that's right.
Moving it back to the investment point, what do we think this means in terms of the shape and nature of investments? Does it mean any seismic shifts? Is it just kind of same old ups and downs that we saw before? Does anyone have any sense of whether this means really?
Yeah, I can tell you, I'm right in the middle of a fundraise. I had the great fortune that I went out hard the first 6 months before COVID, and I saw most of the people that I wanted to see. But there are people that are not going to invest in you if they can't travel. I mean, just full stop. Some of them will, some of them I have, long-standing relationships with, and they're in due diligence and so forth. But if people can't travel, on the whole, you're going to have a hard time getting them to invest. So it's not, this remote technology and this remote situation is not conducive to fundraising. That's why Roelof is going to Oslo and is going to have to self-isolate most of the time he's there to go to a dinner. He's getting on a plane and he's going.
Yeah, I mean, I think in terms of the asset management, no, I think in terms of the asset management, I think that, again, it highlights what we were talking about before, which was, almost every big pension, endowment, et cetera, if you read the reports, were moving real estate into a larger asset, a larger piece of their pie, right? And they viewed it as a store of value. And that was one of the reasons to do it. So you were already having much more money enter the space. And that meant that if you were an investment manager, you were looking at data more heavily, you were looking at analytics more heavily, you were trying to figure out your edge. And I think now it's just even more heightened, right? Because you've got the uncertainty of that. And I think that's where local data, local like analytical tools, those types of things are going to be even more important. And I think that what that likely means is that, it's just like any other cyclical event, right? I think you're going to have winners and losers through that, and those with strong balance sheets, good analytics, good investment in tech, good experiences, good brands are going to last through this, and those that don't, I think, are going to have a tough time. I think the small and medium players that are what I call just asset managers, right? Just putting money in and then praying for the best, are going to have a tough time. And I think what you'll probably shift into is a much more value add play, right? Where I think the value add, as opposed to the core plus, is going to be very, very key for investment managers, because they realize that you're getting into a choppy water and you're going to need someone that, knows how to get their hands dirty, or at least knows how to partner with people who know how to get their hands dirty. Yeah. And I think that's going to be key as part of it. I think the old days of kind of, hey, we're going to sit at our desk and move our chess pieces around and then wait for 5 years and sell everything, I think that's gone, right? And I think all of that has been part of it, which again, harping on this leads to, more tech and more tech and operational focus as part of that experience. And, I think it presents a tremendous opportunity if you have a different view, right? If you have a ability to operate, an ability to create a better space, I think ultimately we will all be better for this, right? Because I do think that if you think about it, right, it's kind of a moment of truth for office. I mean, if you think about it, right, putting the mirror back to the real estate community, and I'm part of it, why is it that people aren't begging to go back to the office as much, right? You have to kind of question that, right? Why is it that, we aren't, like, there isn't this massive outcry for people to say, let me back into the office, right? And I think it's because the experience probably for most people is not the greatest. And so I think that looking the mirror back into it, there's a lot we can learn from things like hotels, where I love staying at certain hotel brands. I absolutely love it. I love checking in. I love the experience they give me. I will stay there every time and as much as I can. Why is it that the office experience is not always like that? And I think that's going to have to change. And so, yes, maybe we have less office space, but maybe we have more communal space. Maybe we have more open space. Maybe we have better amenities. Maybe we have better services. And overall, I think everyone will be better for that.
Yeah, it's on that side, that will be a question of who's going to pay for it, right? So
right,
real estate's not free, and so someone's going to have to provide the service, and there's no question that there's demand for the service, but who's going to pay for it? And I think that will balance out. And I mean, to the point that why isn't everyone wanting and rushing back to the office today? I think short term, it's just fear still, right? No one wants to get on the tube, as an example, in London. If you look at kind of the population in London that's back in the office, it's still small, but that too will pass, right? I mean, COVID is something that's here and today, but over a period of time that will pass, and there'll be different challenges in the future, but we'll all overcome this. There's no doubt about that.
Well, I think Yeah, so to slightly disagree, the only thing I would say is they are rushing to get back to the pub, and are rushing to get back to the social things. So to be fair, I think people are willing to congregate. I think it's just, what are they getting out of it, right? So it's the risk reward, right? And I think
Right.
that's kind of how to,
Fair point.
think about it. But I see your point, just to be fun there.
We've been given 3 huge topics for a small webinar. So I'm going to shift on to technology, but just quickly before I do, and maybe one for Audrey. We've had a question from the audience. Roloff said smaller asset managers will struggle. Isn't this an opportunity for the development of niche specialist firms?
Yes, I saw that question. That's a good one. I definitely, whenever you have great disruption like we're having now, there's definitely space for niche firms, and I think a lot of that, there are investors that like niche opportunities anyway. So post 2008, you did see people were not looking for pan geographies, pan asset classes. They were looking for niche and more concentrated opportunities because of the disruption of 2008, 2009. People were looking for more control. They were looking for more focus, and so you will have, and investors will drive this. You will have investors that will latch on to a niche opportunity naturally, so yeah, I thought that was a really good question. And I think there's definitely room for that.
Okay, I'm going to move on to tech, which is tech and data, which are terms that strike fear into the heart of many into the real estate sector. Neil, maybe you want to start with this one, kind of good general question. The wider availability of data and the greater potential of data offers real potential. What part's data going to play in future investment decisions?
Well, I guess, to your comment that everyone's fearful of tech and real estate, perhaps just to clarify that the cloud doesn't mean it rains in the clouds, right? The cloud is a secure platform that people can utilize to share data. I think data has always been an important part of real estate in terms of investing and understanding time and placemaking, et cetera. And so what better technology tools, though, allow us to do is to better assimilate that with other data points and make better decisions. So whether that's the allocation from an institutional investor in terms of geographical and what type of investments, down to improving the operational cycle of an asset itself and using some of Fifth Wall's investment companies to be able to better leverage and manage that, right? And so the assimilation of all this data will eventually help us, and this is just a gradual process. There's no silver bullet to be able to do this, but it's to make decisions more meaningful based on better data, and then be able to analyze it more, and then be able to use more predictive type of elements to help us in that decision-making process too. So for companies that aren't embracing technology, I think that they'll fall behind. And I think oftentimes COVID creates this disruption and fear, and this is when some of the best innovation happens, because disruption causes the ability to create something new, and we see that happening at this stage too.
Roloff, what are some of the ways that kind of technology can harness some of this data and use it, and what's the kind of future opportunity for it, I guess?
Yeah, obviously we have 2 great sponsors here who are helping customers in that particular way. I think there's a few aspects to it. I think there's your internal data, right, which is how are you harnessing it, how are you structuring it, how are you saving it, and is it done in a way that you can easily retrieve it and analyze it, right? So there's both the kind of data as the reservoir, and then there's the tool that looks at the reservoir and calculates and analyzes all that data. So I think you kind of need to get your own house in order, and there's a lot of experts out there that help on that, which kind of has nothing to do with new tech. That tech has existed a long time. It's much more just about your internal processes and making sure that you get that. And we're seeing more and more companies do that. Blackstone has a really interesting program called Revantage that is looking at this. And again, I think the scale advantages will help in this particular case. But in a lot of senses, a lot of really massive firms don't even do this at all. And you'll be, it's remarkable because they're not really getting the advantages of scale because of that. So I think there's the in-house that's part of that. And then I think the second thing is both the analytical tools that you're using to get the insight, and then also the new types of data that's out there that you may not be using, right? So are you looking at demographic data? Are you looking at climate change data? Are you looking at, public planning data that's incorporated, right, with the mass changes that are happening with that? I think those are all edges that people are looking at. And then in terms of the tools, it's two things, right? It's both the analytical tools that you're using that maybe give you a little more insight, but then it's also tools that are going to potentially replace some investment managers. And, especially with artificial intelligence and machine learning, we're seeing a lot of companies out there that are essentially creating a black box and saying, hey, this is my quant blank blocks, and I'm going to underwrite an asset for you. And, you won't even need to have to pay these big teams and et cetera and do that. And I don't know if that'll help a lot in private equity or kind of really sticky deals or really hairy deals that take a lot of analytics and take a lot of value add. But certainly I think if you're a more index manager, right, where you're basically getting beta from investing in that manager, I don't know why you wouldn't use these tools for cheaper, right? I think that if they get, especially if you test them a few times and they get basically what your appraisals are getting, or they basically get what your analysts are getting, it seems like a no-brainer. So I think you'll have a lot of those particular areas that will be important going into the future. Likely the AI will be a help at the beginning, where you'll do your own analysis, and then the AI will do the analysis, and you'll say, okay, that's interesting. We came up with different values. What did they look at that we didn't, right? But then beyond that, there is the chance that they'll replace a lot of the managers out there.
Audrey, if you're okay to take one, I can't tell if your tech's okay. You're struggling. I've had a question from the audience, which is, how does the UK compare to other countries in terms of their use of data and technology? Do you have a sense of that working internationally?
Yes, UK compares very well. We were having this discussion the other day. As far as, transparency in real estate, as far as like being able to value properties and being able to, determine rents and so on and so forth. That type of transparency is obviously very, very important. And the UK is way ahead of its continental European neighbors. It's probably not as far along as the US, just data and technology in general. But that's for obvious reasons. I mean, the US has a history of coming up with, technology solutions, mostly because of, all the universities being kind of part of, a major research hubs. And, so the UK compares favorably. So I don't know, Roloff, do you want to add to that?
Yeah, I agree with that. I mean, I think in the property markets, if you looked at pricing, particularly residential, and then I think commercial, UK is pretty good versus the US. And I think in general, pretty good, bankruptcy laws, things like that. I mean, I think, there's good rule of law, et cetera. I think it's always the flip side, right? Because the lack of data transparency also creates alpha. So it's always an interesting thing, right? If there's more data transparency, you're like, oh, that's great. There's more data transparency, but then also that's less alpha, right? Because there's less inefficiency. So it's always kind of a flip side if you're an investment manager. I actually think that's the potential for the rest of Europe, is that if you can figure out new ways to hack data and get new data streams and get something other people don't, that obviously is a big competitive advantage, particularly in residential, where I'm kind of shocked when I go to certain countries and there's no, what we call an MLS system, right, or a listing service. So it's kind of like, how do people buy houses if you have no idea what the comps are, right? And you have to end up calling 4 brokers and take an average. And so I think that there is an opportunity there. I think what's going to be key is actually, I do think that the world as it develops is just going to get more institutionalized real estate wise, right? I mean, the money has to flow in these pockets. And as that happens, data transparency will happen. I think ahead of that, what will be interesting to see is how people bridge the gap from, today till the MLS or a multiple listing service. And I think that's going to be kind of the key of, are there going to be data tech tools that entrepreneurs come up with that fill in that gap or become the default prior to that other thing, right? Yeah. There wasn't always a multiple listing service in the US. At some point, people had to get together and say, we should do this, right? And so I think that that's going to be kind of the interesting realm going forward on that particular realm. But I think the UK is pretty strong in that realm.
Yeah.
Neil, where do you and Yardi see the main potential for advances using technology and data in real estate? Where do you see the opportunities?
I mean, we see it in several areas. So, on one side, we could take a very basic example of residential or build to rent, i.e. multifamily, in terms of purpose-built, institutionally owned apartment blocks, and how this is becoming a paperless process versus what it traditionally is using high street letting agents. So the ability to identify a location that you'd like to live in, identifying a property and a unit, making an online application, signing a lease online, to receiving a digital key, to making a payment and moving in. This is a paperless process that one can do today, but a lot of organizations haven't implemented the infrastructure to do this. And so it's not too different from how hospitality works today, by which if I check into a certain hotel brands, I never have to talk to the receptionist, either checking in or checking out. And I think we'll get to that same point across mass-based residential platforms in the UK, not too dissimilar to what's happening in the US. I think oftentimes where there's this disruption with technology, it's disrupting the incumbents. And in this case, the incumbents are the different real estate agents, and so, or other providers. And so, Rolf, if you spoke to MLSs, so in the Netherlands, as an example, the primary MLS is owned by, quote unquote, the makelaars, which are the real estate agents. So there is no desire to provide you transparency on Funda, because they want you to go rent by a makelaar, and there's that transaction cost, there's that friction that is purposely still created, and there's obviously lots of groups trying to change that. But I think that example of a paperless process as it pertains to residential and student will also apply to commercial in time. So the ability to execute documents online, the ability to streamline the complexity of signing a corporate occupier lease, which today is hugely complex, and kind of the lawyers also make it complex, to be honest, and the owners on both sides. The ability to streamline that, bring friction out of it, which also means that you minimize costs involved in the overall process, and that creates value too. So those are some things that we actively look at in terms of just the overall lead to lease cycle, and then how one is able to aggregate that data, share that data, and then make additional decisions off of it.
So for the last bit of this webinar, I want to move on to the discussion of new asset classes. And with the advances in technology, which new asset classes do we think can be unlocked? Does anyone want to tackle that question?
There's so many, right? So on one side, we would say that this idea of flexibility in an office, right? And that drives, I think, one of the biggest areas of growth will be this expansion of the definitions of business centers, co-working, now flexible space, right? And so the UK was really one of the founding originators from a market point of view of business centers, and was the leading in co-working. And then this small brand out of the US took kind of over this idea that they created it all, i.e. WeWork, and that's maybe had some challenges as people will have read and noticed in the marketplace. But I think the basic tenet of that flexibility is required will reshape how offices and office space overall is managed. And I think that's a very big area. But then I also think that utilization of space closer to the customer will be prevalent too, and the expansion of delivery systems. And Rolf, I think the other day you mentioned or provided an example of ghost kitchens, and so people who aren't familiar with that term, it's this idea of Deliveroo, or name your local delivery service, is that there's actually kitchens, purpose-built kitchens that are outsourced to different restaurants, that they can bring their cooking services closer to their customers without having to make the full investment themselves. And so that's a novel idea, as are additional data centers and light logistics centers closer to the end recipient.
Thanks, Neil. Rolf, new asset classes that can be unlocked thanks to all these technological advances?
Yeah, I mean, I think one that we saw in the US that I do think will happen here is what we call single-family rental portfolios. So I think that with the advent of built-to-rent and how popular that's become, and how I guess it's young but successful it's been, I do think what you're going to start seeing is institutions going to buying big swaths of single-family homes upon the case of tens of thousands. And the only reason they can do that now is because there are platforms out there, what we call iBuyers, that will allow you to buy dozens of homes in a single swath. And so the one we backed in the US, in full disclosure, was called Opendoor, and then it facilitated a number of companies out there to be able to do that. So originally there was a company called Invitation Homes who built their own tech, but then Opendoor set up an iBuying platform. And now you could go raise $1 billion. You can go to Opendoor and you can say, look, I'd like to buy suburban Atlanta, suburban New York, this area. This is what I can pay. This is kind of what I'm looking for. And they'll go and they'll buy it as soon as it hits the bid. And I think that was what was always holding back. I think a lot of people had the idea of, just buying homes and renting them. I think the challenge before was that it's like build to rent flipped on its side, right? Spilled on its side. It's basically a distributed asset. And so the challenge you had initially was, well, how are we going to go buy thousands of homes? And so now that technology is there, there's a number of iBuying platforms that are emerging here in Europe. And then you also have the tech to manage that asset across. And so I think that that's going to be a big area. And then I think the ghost kitchens you mentioned, which is kind of outsourced commissaries, certainly for obsolescent retail, certainly for older infill logistics. And then I think the next one is certainly going to be what we kind of call like last 100 meters delivery, right? So back of store logistics, mall logistics, converting these retail locations into those particular logistic hubs, I think are going to be key. And then one other, which I know is a hot area right now, which is data centers. I do think that you're going to start seeing what we kind of call infill data centers. So there's a lot of open space in cities that are near big electric centers or are in buildings that would be great hosts for data centers. They're closer to the end user, so you don't have as much latency. And in addition, it's near a central electric hub. It does create quite a bit of heat, so you'd have to figure that out. But we're looking at a lot of startups that are in that area that are saying, okay, this office building in London has a completely empty basement that's not being used. Could we put a data center in there? And I think that you're going to start seeing these kind of infill opportunities that are out there.
Just a quick side comment, Rolf. So, Rolf, the comment of single-family homes, totally agree with that. What's interesting is that the biggest single institutionally owned platform of single-family homes, i.e. in UK speak, would be PRS. They've pointed the ship entirely for build to rent, right? They're trying to do everything to allocate that capital and put it into build to rent. But there's certainly an opportunity on both sides. So.
Yeah, I think that I do think you'll see the emergence of multifamily, and there's a reason you want to do multifamily probably ahead of single family, just because it's just logistically a lot easier, right? You have higher density. It has a lot more synergies to it. But I think if you look at mainland Europe, where building or developing a lot more apartments is basically impossible, you'll likely have that institutional capital point towards that. And I think a lot of it is just driving it is people feel residential is a store of value. And so because of the shift from the store value to maybe office to a little more to residential, people feel good about residential. They feel like it needs to exist. And so I think that that's where you're seeing the capital flows. But I agree with you. I think that's a good point.
Audrey, do you want to come in on that new asset classes? Is that chime with what you're experiencing?
Yeah, no, I really, I think we're going to see some really interesting things come out of retail. I think you're going to see a lot more, experience retail as experiences, or experiences replacing retail in many ways. I've been reading a lot about that space. Like I really have enjoyed seeing what Boxpark has done. I don't know if you're familiar with Boxpark, but they've been on the cutting edge of reinvigorating retail into an experience.
Yeah, it's such a great point. I mean, retail is all about not just the ability to shop, but it has to be an experience, and it has to be with a vendor that you want to experience too. So I think those vendors that supply product to the market, but there's not a strong brand attachment, that will go online, right? And I think that's an easy kind of a decision point to make. And I think then as an owner and operator of retail space, ensuring that your tenant mixture is correct and has long-term viability based on that experience factor is so important. And traditionally, to a large extent these days, I think over the last few years, is that retail platforms have just been filling space, right? Less concerned about the long-term longevity of the brands and just, not being reckless about it, but to a degree lacking some of the longer-term strategy in terms of whether it actually makes sense. They're just trying to make sure that someone is in that space so that the mall doesn't look half empty.
So before we give Neil and Yardi the final word, I want to ask you all one final question. You've all got a crystal ball and you're able to look 10 years into the future. I want you to tell me what real estate, what asset management is going to look like in 10 years and what the significant changes will have been. Roloff, you seem like a futuristic chap. What you like in 10 years.
Yeah, well, I think I did another panel with Audrey, and it said, tech in 2030, and I think a lot of us were just trying to make it to 2030, given this year. But I think biggest difference in terms of asset management is I think, and it's partly the asset management. I think there's going to be a hyper focus on fees, and I think you're going to see a lot less steps in the process. And so, and then a lot of data and analytics on that particular end. I think that there are just so many middle people in a transaction now and so many fees. It's absolutely unbelievable. And I think with the pressure on rates and where it is, I think you're going to see a huge focus on the operational efficiency there. Tech will obviously play a big role. And I think you'll be amazed at how much simpler and better the transaction experience is in 10 years than it is today.
Okay, interesting. Neil, 10 years time, what's it going to look apart?
Yeah, I mean, I agree with that. I think
we're going to be knackered from this year.
Yeah, yeah, we're going to take a break in 2020 or
2022,
I think. 2021, I'm losing track of time. But I think, yeah, in 10 years, I mean, I think technology is going to help automate a lot of the processes. And I think with automation and faster decision making, it cuts out the middleman, so you reduce fees. That's just a natural progression of kind of any industry. I think that will put increased pressure in terms of finding value, though, too, right? I mean, it will be harder to find value. Real estate at the end of the day is still kind of a location component, but it's understanding how that definition of a location changes. But I think those firms that don't invest in technology will be handicapped because it's more than just a relationship game.
Okay, thank you. And final word on this to Audrey. 10 years time, Audrey, what's the asset going to look like?
Well, I think one of the positive things that's going to come out of this pandemic and the situation and the acceleration of the use of technology is that it's going to level the playing field. I mean, the diversity and inclusion is a big subject right now, big theme running through, investors' due diligence and things like that. And, I think that, for example, technology allows women with kids to spend 2 days at home, 3 days in the office, or 3 days at home, 2 days in the office, et cetera. It just, we have, although not, in my opinion, completely ideal, we have seen that this work from home thing actually works, that businesses don't fall apart. So I think it's just going to level the playing field for a lot of people who need to be at home for certain reasons a couple of days a week or more.
I love that, and I totally agree with your side analysis there. As someone that seems to be doing a lot more laundry when they're working at home while their partners are out enjoying more time at the office, building up social capital. I'm not sure how that works, but yeah.
Well, it also means you don't always have to wear long pants, right? So you could be sitting in a nice shirt with your shorts on. So
nothing below the waist is fine. Anyway, on that note, Neil, I'm going to hand to you to say a few words on behalf of Yardi to finish our webinar.
Yeah, I just want to say, big thank you to all the panelists today, and also on the previous panels that we've had. This has been the third in the series of just a great set of conversations talking about real estate and the different aspects of real estate and investment and technology and trying to look in that crystal ball, which is so hard to do. And it's like anything else, it would be really interesting to see, in 12 months from now, what we all think, and then fast forward in 5 years, because we probably all get it wrong, because had we sat here 12 months ago forecasting what 2020 was going to look like, clearly we were all wrong, or maybe not totally wrong, but certainly no one would have anticipated COVID. So big thank you, Anna, for hosting us today, and big thank you to David and the entire team at Movers and Shakers. It's just been pleasurable. And one thing to remember is that disruption, like what COVID has caused, creates opportunities, and so it might be distressing at certain times, but there are jewels to be found, and this is an opportunity to drive innovation in everything that we do. So thanks again for hosting us.
That's brilliant. Thank you very much. What a great session, and well chaired, Anna, and great contributions from everybody. I've got to tell you, I started to make some notes, and I got so absorbed in what you're saying, I didn't make too many. So this is going to make the summing up a little bit difficult, but so just a couple of points. I'm not going to pick up on many because of the time thing, but you know, I think you're right. I think we agreed the office isn't dead, and Audrey made a great point about the development of young people, the development teams. Somebody on one of our previous sessions talked about, you know, the fact you need to be together to drive innovation. I totally agree with that. I also, you know, all those young people out there, just bearing in mind that Audrey is available for
I was going to message Audrey afterwards asking her to mentor me. I thought it was excellent.
We'll put her email out there, possibly on Zoom groups.
Audrey.klein@mentor.com.
Interesting bit about local data and analytical tools will be more important. And that, you know, the converse that small asset managers may struggle, but maybe not. And I think it's a good point Audrey made. Maybe not if they do become niche players and become specialists in marketplaces. We'll see an increase, definitely. I mean, I suppose it's inevitable, isn't it? We're going to see an increase in the use of data, and I think Roelof made the point about good data and unique data being the opportunity for real competitive advantage. I was also fascinated with the point about where the UK standed in the league with the rest of Europe, which was interesting. So technology, point that Neil made, you know, technology is there. Maybe this is always the case, but it's not universally being adopted, but it's going to increase because we're going to be challenged more. And that's what happens in situations like this. You know, the new asset class is really interesting about the utilization of space, single family rental. I think you're right, actually, Roelof, about what you've seen happen in the US could happen over here. And technology is the real enabler for new opportunities. Last 100-meter logistics, a lot of work being done that. The converting and repurposing of town centres. And I love the bit about data centres. It's really interesting stuff going on there. And then looking at the future. And the only point I'll pick out there, and I love the point that Audrey made, and we were talking about this the other day, that this technology is a great enabler for diversification. And I was talking to somebody who said exactly what you said, that, you know, this enables me to actually carry on and have a career and bring up a family, and all those things, and also people with disabilities. This is a great opportunity. So listen, guys, that was really, really good. Thank you to Yardi for sponsoring this series and for their support throughout. Our next event is delivering more and better homes in the West Midlands with Councillor Ian Ward of Birmingham City Council tomorrow. But thank you all for joining us. Thank you to our panel. And from our family to yours, as always, stay safe. Thank you very much.